Hello and welcome back to the Financial Freedom Show. In today's episode, we're going to be talking about why Warren Buffett owns VOO. If you enjoyed today's video, please be sure to hit the like button and don't forget to subscribe in order to stay up to date with the latest videos we post on the channel. As well as leave a comment down below. Are you adding VOO to your portfolio? Or do you like to buy the S&P 500 in a different ETF form? Let us know in the comments down below. I'd love to read them. So if you enjoyed today's video, remember to comment down below, and without further ado, let's get into the video. So Warren Buffett is one of the most successful investors in history. He has consistently recommended low-cost index funds as the best investment strategy for the average person. Specifically, he has frequently praised the Vanguard S&P 500 ETF, or VOO, as an excellent choice for long-term wealth building. Buffett's endorsement of VOO is based on several key factors: diversification, low fees, strong historical performance, and the difficulty of beating the market. VOO tracks the S&P 500, an index that includes 500 of the largest publicly traded companies in the U.S. By investing in VOO, investors gain exposure to a broad range of industries involving technology, healthcare, finance, and consumer goods. This diversification helps reduce risk compared to investing in individual stocks. Buffett has often stated that most investors should avoid picking and instead own a piece of America's best businesses through an index fund like VOO. One of the main reasons Buffett prefers VOO is its low expense ratio. VOO has an expense ratio of just 0.03%, meaning investors pay only $3 per year for every $10,000 invested. Over time, high fees of actively managed funds can eat away at returns, whereas low-cost index funds allow investors to keep more of their gains. Buffett has frequently criticized high-fee mutual funds, arguing that they often underperform the market while still charging unnecessary fees. The S&P 500 has delivered an average annual return of about 10% over the long term. Buffett has pointed out that very few investors or hedge funds consistently outperform this benchmark. Rather than trying to time the market or pick winning stocks, he believes that investors will do better by simply buying and holding VOO for decades. Buffett has spent decades studying the markets and believes that most active investors will fail to beat the S&P 500 over time. Even professional fund managers struggle to consistently outperform the index after accounting for fees. This is why he advises investors to bet on America by investing in low-cost S&P 500 ETFs like VOO and holding it for the long run. Perhaps the strongest endorsement of VOO comes from Buffett's own estate plan. In his 2013 letter to Berkshire Hathaway holders, he revealed that he instructed his trustee to invest 90% of his wife's inheritance in a low-cost S&P 500 index fund like VOO and 10% into short-term government bonds. This demonstrates his deep conviction that an index fund like VOO is one of the safest and smartest ways to grow wealth over time. Warren Buffett is one of the most successful investors of all time, and he's known for his disciplined, long-term approach to investing. Rather than chasing quick profits or trying to time the market, Buffett advocates for investing in strong, reliable assets that grow steadily over time. His preference for the S&P 500 as a long-term investment is rooted in several key principles: the power of compounding, the difficulty of market timing, and the strength of the U.S. economy, and the risks of short-term speculation. One of Buffett's biggest arguments for long-term investing is the power of compound interest. The stock market has historically delivered an average annual return of about 10%, but these gains don't just come in a straight line. Instead of focusing on short-term fluctuations, Buffett encourages investors to stay invested for decades, allowing their money to multiply over time. For example, an initial investment of $10,000 in the S&P 500 that grows at 10% annually would become $25,900 in 10 years, $67,200 in 20 years, and $174,500 in 30 years. This exponential growth is only possible when investors stay the course and avoid the temptation of frequent buying and selling. Many investors attempt to buy low and sell high, but Warren Buffett warns that even the smartest professionals struggle to time the market correctly. Short-term traders often get caught up in the market hype and panic, leading them to make poor investment choices. Buffett believes that predicting short-term stock movements is nearly impossible, and history shows that those who often try to outperform the market are the ones who underperform, those who simply hold a broad market index like the S&P 500. Buffett once said, "The stock market is designed to transfer money from the active to the patient." This means that investors who jump in and out of the market often end up losing to those who simply stay invested in a solid low-cost fund like VOO. Buffett's preference for the S&P 500 is tied to his belief in the long-term strength of the U.S. economy. The S&P 500 is made up of 500 of the largest and most successful companies in the United States, including Apple, Microsoft, Amazon, Google, and Johnson & Johnson. These companies innovate, grow, and adapt to changing times, making the S&P 500 a reflection of the overall economic power of the country. Buffett has often said, "Never bet against America." By investing in the S&P 500, investors are essentially buying into the continued success of American businesses. Over the past century, the index has recovered from wars, recessions, and financial crises, and it continues to rise over the long term. Buffett has repeatedly warned against speculative trading, such as day trading, meme stocks, or trying to chase trends. While the short-term gains may look appealing, they often come with high risks and emotional decision-making and losses. For example, many traders who jumped into the stock market during the 2021 bull run lost significant amounts of money when the market corrected in 2022. Buffett believes that investing should not be treated like gambling. Instead, he advises investors to buy great businesses or a broad market fund like the S&P 500 and hold them for decades. His most famous quote is, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett's preference for the S&P 500 and long-term investing is based on logic, history, and experience. He believes that staying invested, avoiding speculation, and letting compound interest do its work is the best way to build wealth over time. Instead of chasing short-term gains, he encourages investors to buy and hold great businesses, trusting in the long-term strength of the market. By following Buffett's wisdom, investors can avoid costly mistakes and secure their financial future with steady, reliable growth. Warren Buffett's recommendation of VOO is based on solid fundamental principles, broad diversification, low fees, and strong long-term returns, and the difficulty of beating the market. Instead of chasing stock-picking strategies or high-cost funds, he believes that most investors will achieve the best results by consistently investing in VOO and holding it for decades. By following Buffett's advice, investors can take advantage of the power of compound growth and secure their financial future. If you enjoyed today's video, please be sure to let us know in the comments down below if you're buying VOO in your portfolio or another S&P 500 focused ETF. If you enjoyed the video, be sure to hit the like button and subscribe in order to stay up to date with the latest videos posted on this channel. Feel free to check out our membership link in the description, and I hope you guys enjoyed. I'll see you next time.